But our next guest says there's still a reasonable chance that we don't get any rate cuts this year. For some perspective, let's bring in Chuck Lieberman, Managing Partner and Chief Investment Officer at Advisors Capital Management. Chuck, thanks as always for joining me. What probability would you put on it that we don't get a rate cut this year?
25%, not a huge probability, but nonetheless not one to be dismissed.
And let's talk about what are the factors that you're looking at right now. How nimble do you have to be around that probability?
Well, the economic data keeps on coming in a bit more solid than people expected. There was just widespread anticipation of a recession. There's none in sight, and we keep on seeing very solid job growth. Well, in excess of 200,000. That's a whole story because that's partly driven by immigration. Domestic population growth is just not adequate to meet the needs of companies. And the run rate for hiring is well in excess of what's being driven by demographics. So a lot of the difference is made up by immigration, some of it legal, a lot of it illegal. Nonetheless, those people coming across the border need to work. Otherwise, they can't support themselves, and they're finding jobs. So we see very strong hiring. And of course, again, those people, when they earn an income, they go out and they spend. Just like everyone else, they need to buy groceries. They go to the movies. They need to buy a car, you name it, and they're doing it. And the end result is that the economy continues to roll ahead.
And so if that's the factor, right, if you do have that growth, if you do have the employment picture, and we don't get the rate cut, is that a problem for the markets?
Well, I would turn it around and say, if you don't get a recession, if you have continued growth, that's great for corporate profitability. So you have both a push and a pull, one that's a very positive force, which is the growth in the economy, the growth in profits, and the other higher rates than anticipated. But obviously, those rates are not stifling demand. They're not stifling the economy. The economy is doing fine. So I would say the net result is kind of neutral, but slightly positive.
Does it make sense to you, because that is the underpinning, that we are seeing this broadening out of the market rally, sectors outside of tech doing really well, materials hitting fresh all-time highs, industrials also, they did well in the first quarter, obviously hitting all-time highs, but continuing to hold in?
Yeah, that's exactly right, Amber. You hit the nail on the head. When you look within the market at how sectors are performing, one of the sectors that's performing relatively poorly is utilities, and those are bond proxies. The bond market has continued to struggle. Rates came down when the market expected the Fed to cut, but every time they see strong data, rates back up again. The bond market sold off sharply today, as an example, in response to the very solid ISM numbers. So the bond market struggles, and therefore the utility sector struggles. But the more cyclical parts of the economy, the more value-oriented parts of the economy, those are now starting to enjoy the rally. And we are seeing that spread out.
Are you nibbling away at any bond proxies? And that's been a real tough trade to do that, because valuations might speak to you, but if bond prices are going to sell off like they are, it makes it a really difficult environment.
Thank you very much for looking inside my portfolio. So I manage the income with growth portfolio, which is an equity-based income portfolio, income-oriented portfolio. And my benchmark includes a lot of utilities, and I think they're very, very vulnerable. So I'm keeping my utility exposure at the absolute minimum level because they've been weak performers, and having a minimal exposure to utilities has been beneficial to performance. But there are other parts of the economy that continue to grow, and that's where I'm putting my dollars, client dollars.
What's an example of growth income?
Well, it's income based on equities. So the concept is that we want our clients to have income, and we want that income to grow to keep up with inflation. And so you can't do that in fixed income. You've got to do that in equities. And there are lots of companies out there, established companies, pay very good dividends. and their dividends grow over time as the companies make more money. So this portfolio is based on those types of companies, those type of securities. We have some fixed income exposure. Clients in this kind of situation, many of them are retired and living off their portfolios. So they prefer stability if possible. So we have some allocations to fixed income, but we keep our duration short to minimize the damage of rising rates.
Let's talk about interest rates as it relates to the financials, the banks. We're going to start to get into reporting season. That kicks off next week with JP Morgan. And we've seen a recovery in some of these bank stocks that were beaten up. Of course, JP Morgan, continued unfettered. Is this a sector you're taking a look at, or how does your interest rate view dovetail with whether you're seeing opportunities in financials?
Well, we think the banks are at maximum pain right now, and we like them a great deal. The big money center banks are all cheap across the board. JP Morgan being the best run of the lot also is the most expensive, but you're paying up for value. Citi and Wells Fargo, very, very cheap stocks. We expect them to do very well in the future. They've actually been very solid performers, very strong performers over the last couple of months. And then you get to the regionals. The regionals have more real estate exposure, and that's now the hot button subject. People are worried about the excess overhang of commercial office properties. And that's a real problem for companies that have excessive exposure. The money center banks don't. Some of the regionals do. And there was an interesting report put out by S&P within the last day or so, suggesting, giving names actually of some of the regionals that had a lot of exposure, but everyone else has been taken out and shot just in sympathy. The market has a tough time evaluating just how much exposure these guys have and the quality of their exposure. It's not just the quantity, it's also the quality. The money center banks tend to be very tough lenders, demand a lot of equity be put into real estate. They don't want the loan to value to be too high. So even if values have declined, the borrowers can service those loans. At the regional bank level, it's not quite as good a story. And so it becomes a case-by-case study, and you have to pick out the ones that are likely oversold relative to their risk.
Well, let's talk about an example of that, because we've seen some, they call them super regionals, recover their losses from Silicon Valley Bank a year ago. Fifth Third would be a great example of that.
Well-run institution. It basically has a lot of coverage in the southeastern part of the United States, which is doing very well, growing very nicely. A lot of population inflows into the southeast. And so it was taken out and shot along with the others, but that made it a very, very cheap stock. And as a result, we think it offers tremendous value. So we own it in our income-oriented accounts.